So I think if you look at the prediction markets, they haven't shifted that much in terms of the likelihood of Republican or Democrat victory on this news. And I think for the markets, I mean, in Europe, as we've discussed before, the main issue is Trump gets in and imposes tariffs, really.
If Trump is still the leading candidate, so at the moment, and by the way, she's not even a presumptive candidate as well. I have to keep saying that because our team are very hot on the standards, and if I come off it, I'll get a real rap on my knuckles if I call her the Democrat candidate, which I'm not doing, by the way, team. Anyway, so Trump is still ahead in the polls. So we work on the assumption that he is slight favourite at the moment. If he gets in, how bitter a blow will that be for European equity holders, or actually is that already in the price?
You know, Trump, last time he got in, first time he got in, no one really knew what he was going to do. The markets were nervous about it, but actually he did tax cuts and that was seen as a benefit. And you saw cyclical recovery as well at the time. And equity markets generally did very well, including Europe. Yeah. The problem this time is that he has less scope to easily do tax cuts, given the fiscal position of the US. But also the problem is he's talked about 10% tariffs on all goods coming into the US, not just goods from China, and obviously that will hit Europe.
It will also hit the US consumer as well if he puts tariffs out left, right and centre. So is that economically self-inflicting harm, given the fact that the US runs such large deficit? Or actually, will it rebate? Actually, will it do good for US manufacturers, which outweigh the extra cost for US consumers?
Yes, and maybe US employment, which is what he's targeting there, isn't it?
US employment, I mean, I say this relatively ignorantly, US employment isn't the problem at the moment.
No, it looks relatively good, doesn't it? I agree. And we actually think that if he does impose these tariffs on goods coming in, it will add about 1% to US inflation, which is enormous, really large. And of course, all other things equal, that will mean the Fed will do fewer rate cuts if inflation is higher and stickier for longer. So yes, it's difficult to see it being a huge positive for the US economy either. In fact, we think it would take about 0.5% off US GDP, which is surely not his intention. So I think, of course, he might temper this policy. That's quite possible. I mean, rhetoric going into election and what you actually do can sometimes be a bit different.
Sharon, I mean, Invesco's survey says that geopolitical rivalries, including brewing trade battles, like you said, between the US and China, now trump inflation as the biggest worry for sovereign wealth funds as well as central banks. Is the market perhaps letting go of the notion of inflation being as significant a little too quickly?
Yeah, because I think all these geopolitical risks and trade tensions are actually inflationary as well. Because if you're adding on extra tariffs to things, you're going to be adding on inflation too. So I think it's part of the inflationary narrative at the moment, these geopolitical risks. In fact, it was the big geopolitical risk between Russia and Europe which really pushed up inflation and energy prices in the first place. So I don't see it as helping to bring down inflation, quite the opposite.